37% gone in one trading day. No breaking news, no emergency alerts, no war, no bank failure, no global crisis, just silence. Silver didn't correct. It didn't cool off. It didn't pull back. It was erased, executed. In less than 6 hours, tens of billions of dollars vanished from the precious metals market. Fortunes collapsed. Positions were wiped out. Years of gains disappeared before lunch. And the most disturbing part? No one on mainstream media could explain why. But there is a reason. And once you see it, you'll never look at markets the same way again. Here's the problem no one wants to talk about. Financial markets are supposed to react to information. Wars push prices up. Recessions push them down. Policy announcements move currencies. But what happens when a market collapses without any catalyst? Last Friday, silver opened the day strong, riding one of the most explosive rallies in modern history. In a single month, it had climbed more than 60%. Optimism was everywhere. Analysts were racing each other with higher price targets. Retail investors felt invincible. Then the New York session opened, and everything broke. Within minutes, massive sell orders slammed the market. These weren't small traders taking profits. These were institutional scale positions dumped all at once. Millions of ounces sold simultaneously, the kind of selling that doesn't happen randomly. Key support levels failed like they never existed. Psychological price floors collapsed in minutes. Automated stop losses triggered across the system. Margin calls went out nationwide. Traders weren't choosing to sell, they were forced to. By the end of the session, silver had lost over a third of its value. Gold followed. Entire portfolios were liquidated. And yet, nothing had changed. No geopolitical shock, no economic data surprise, no policy announcement, no emergency meeting. Just devastation without explanation. That's the problem. Because when markets stop responding to fundamentals and start moving purely by force, something deeper is broken. And when that same type of collapse happens repeatedly across decades, following the exact same sequence, it stops being volatility. It becomes a system. What if this wasn't an accident? What if what you saw on Friday wasn't panic, fear, or a market losing control, but a system doing exactly what it was designed to do? Because here is the uncomfortable truth. Markets don't just collapse like this without a trigger. Prices don't erase decades of gains in a few hours unless something forces them to. And yet, there was no headline, no emergency announcement, no global shock to explain the violence of that move. Silver didn't slowly roll over, it didn't fade, it didn't drift lower, it fell off a cliff. And that kind of fall always leaves fingerprints. The strange part isn't just how fast it happened, it's how familiar it looks. Because if you've studied market history closely enough, you've seen this movie before. Different decade, different price levels, same script. Every time silver enters a parabolic phase, every time it attracts public attention, every time it starts exposing cracks in the financial system, something happens behind the scenes. A quiet change, a technical adjustment, something most people don't even notice until it's too late. The sell-off doesn't start with fear. It starts with pressure. Pressure applied not to the metal itself, but to the traders holding it. Pressure that forces selling regardless of belief, conviction, or long-term outlook. Pressure that doesn't ask permission. And once that pressure reaches a critical point, the outcome is always the same. Forced liquidations, cascading stop losses, algorithms feeding on weakness, prices collapsing far faster than logic would ever allow. But here's where it gets even more disturbing. While paper prices are imploding, the physical market often tells a completely different story. Coins disappear, bars go unavailable, premiums rise instead of fall, vaults drain while screens flash red. Two markets, two realities, one controlled by rules, leverage, and margin calls, the other governed by supply, demand, and what can actually be delivered. This isn't about guessing where silver goes next. It is about understanding why these crashes keep happening at the worst possible moments, and why the same tool keeps getting used over and over again. Once you see how this mechanism works, you'll realize Friday wasn't chaos, it was execution. Friday morning felt ordinary, too ordinary for what was about to happen. It was the final trading day of the month, the final session of the week. Silver had just completed one of the strongest monthly performances in decades. Confidence was everywhere. Analysts were upgrading targets. Social media was euphoric. Traders believed the hard part was over, that the breakout had already been confirmed. Silver was holding above $120. Gold was strong. Momentum looked unstoppable. Then New York opened. At 9:30 a.m. Eastern, the first wave hit. Within seconds, massive sell orders slammed into the futures market. Not gradual selling, not profit-taking trickles. These were institutional-sized blocks. Millions of ounces dumped almost simultaneously. The tape turned red instantly. Silver slipped from $121 to $118. Then $115. Then $112. At first, traders tried to rationalize it. Just volatility, they said, a pullback before the next leg higher. But the selling didn't pause. It accelerated. When silver broke below $100, the mood changed completely. That level wasn't just technical, it was psychological. Entire strategies had been built around it. Analysts had called it a floor that wouldn't break. Stop-loss orders were stacked just beneath it. And once that line failed, the system took over. Automated selling ignited. Prices cascaded lower in violent bursts. $95, $90, $85. Each drop triggered another round of liquidations. Screens froze. Trading platforms lagged. Phones lit up with margin alerts. This wasn't fear-driven selling. It was mechanical. Margin calls began flooding accounts across the country. Traders were being told they needed to deposit large amounts of cash immediately. Not tomorrow, not next week, but within hours, just to maintain positions they already held. Most couldn't. And when margin requirements aren't met, the exchange doesn't negotiate. It liquidates. Positions were sold automatically at market prices, no matter how bad those prices were. Traders weren't choosing to exit. They were being forced out. By midday, silver had already lost more value than most assets lose in a full year. Gold followed the same path, dropping hundreds of dollars. Billions in market value vanished before the closing bell. By the end of the session, silver was near $75, a 37% collapse in less than 6 hours. And yet, the world was quiet. No emergency headlines, no breaking news banners, no urgent explanations. Financial commentators called it a healthy correction, a necessary reset. Markets, they said, had simply moved too far, too fast. But that explanation fell apart the moment you looked backward, because this collapse didn't start on Friday morning. It started weeks earlier. In mid-December, while silver was climbing and optimism was building, the futures exchange quietly raised margin requirements. It barely made the news. Just a small adjustment, they said. Silver kept climbing. Days later, margins were raised again, more aggressively this time. Traders needed more cash to hold the same contracts. Still, the rally continued. Then it happened again. Another margin hike, then another. 4 increases in just 6 weeks. By the end of January, margin requirements were nearly 80% higher than they had been at the start of the rally. That's when the pressure became unbearable. Margin isn't a suggestion. It's collateral. It's the money you must keep in your account to hold a leveraged position. When margins rise, every trader suddenly needs more cash, instantly. If they can't provide it, their positions are sold automatically. Imagine thousands of traders receiving the same message on the same day. Your required collateral just jumped dramatically. Deposit funds immediately, or we will close your position. That's exactly what happened. And when thousands of leveraged positions are forced to liquidate simultaneously, prices don't drift lower. They collapse. This wasn't silver finding fair value. It wasn't a bubble popping naturally. It wasn't investors changing their minds. It was structural pressure finally snapping the market. And if this sounds familiar, it should, because this exact sequence has already played out, more than once. In 2011, silver surged from under $10 to nearly $50. Retail investors flooded in. Short positions at major institutions came under intense pressure. The response was swift. Margin requirements were raised 5 times in 9 days. Not months, not weeks, 9 days. The result was devastating. Silver collapsed by more than 50%. It took over a decade to recover. Go back even further, to 1980. Silver surged from $6 to nearly $50 in a matter of months. Confidence exploded. Regular investors were building life-changing wealth. The response was extreme. Leverage was effectively banned overnight. Interest rates were aggressively hiked. The market imploded. Silver lost over 80% of its value. 3 rallies, 3 collapses. Same asset, same mechanism. And now, here we were again. But there was something different this time. While paper markets were imploding, the physical market was already under stress. Even before Friday's crash, mints were struggling to meet demand. Inventories were thin. Delivery times were stretching. After the crash, that disconnect widened. The screen said silver was cheaper, but actual metal was harder to find. Premiums stayed elevated. Availability didn't improve. 2 markets were telling 2 different stories. One was controlled by leverage, contracts, and margin rules. The other was governed by physical reality. And while Western traders were being liquidated, buyers elsewhere were doing something very different. They were taking delivery. Vaults were being drained. Metal was being removed. Not traded, not swapped, but physically withdrawn. This wasn't speculation. It was accumulation. The crash didn't change the fundamentals. Industrial demand didn't disappear. Supply constraints didn't ease. Years of production deficits didn't vanish overnight. The only thing that changed was the paper price. Friday wasn't random chaos. It was the final act of pressure that had been building for weeks. A system doing exactly what it has done before when silver runs too fast and threatens too much. And once you recognize that pattern, Friday stops looking like a mystery. It looks inevitable. So now we reach the part most people never connect on their own. This wasn't really about silver. Silver was just the pressure point. What actually came under threat was the story holding the entire financial system together. The belief that paper money, paper promises, and digital numbers are stable, trustworthy, and permanent. Gold and silver don't rise because they're fashionable. They rise when confidence in paper starts to crack. When they surge too fast, they broadcast a message the system cannot afford to let spread, that real value is leaving paper behind. That's why the response is always the same. Not regulation, not transparency, not reform. Control the leverage, because leverage is where paper markets are vulnerable. Futures contracts allow massive exposure with relatively little capital. And when prices rise, leverage amplifies gains. But when margin rules change, that same leverage becomes a trap. Raising margins doesn't just cool a market, it forces selling. It turns confident holders into unwilling sellers overnight. And because those rules apply to everyone at once, the selling becomes synchronized. That's the lever. And it's been pulled before. Every time silver threatens to break the narrative. In 1980, silver was exposing inflation and currency debasement. The response crushed it. In 2011, silver surged during a post-financial crisis world drowning in money printing. The response crushed it. And today, silver surged again. During an era of record debt, exploding deficits, weakening currencies, and central banks quietly preparing for a different future. Once again, the response was immediate. But here's what makes this moment different. While Western paper markets were collapsing, the physical world didn't flinch. Demand didn't evaporate. Supply didn't suddenly improve. Industrial use didn't decline. In fact, silver remains in a multi-year supply deficit, with more metal consumed each year than mined. And while futures traders were forced out, another group was stepping in. Quietly, methodically, without leverage. They weren't buying contracts. They were taking delivery. Physical silver was being removed from vaults, shipped, stored, and secured. That metal didn't get liquidated. It didn't get margin called. It didn't vanish because of a rule change. This is where the paper market and the real market diverge. Paper prices can be smashed because paper can be created endlessly. Contracts can be written, rewritten, leveraged, and forced closed. The exchange controls the rules. But physical metal exists outside that system. It cannot be printed. It cannot be rehypothecated infinitely. It cannot be deleted with a keystroke. That's why this keeps happening. Not because silver is dangerous on its own, but because what it represents is dangerous to the system built on paper confidence. If silver were irrelevant, it would be ignored. If it didn't matter, it would be left alone. Instead, the same playbook gets deployed every time it starts to run. That tells you everything. The crash wasn't proof that silver failed. It was proof that it mattered enough to be stopped, at least temporarily. Prices can be pushed down, sentiment can be shattered, weak hands can be flushed out. But the underlying reality doesn't change. Supply remains constrained, demand continues to grow. Industrial dependence increases every year. And history shows that when paper pressure collides with physical scarcity long enough, the outcome is not determined by rules, but by reality. This wasn't the end of the story. It was the system buying time. Here's where this becomes personal. If you were trading paper silver on leverage, Friday was devastating. Accounts wiped, capital destroyed, emotions shattered. But if you step back and look beyond the screen, something else emerges. Physical silver didn't suddenly disappear. Demand didn't collapse. Industrial use didn't decline. Supply shortages didn't vanish. The fundamentals didn't change, only the paper price did. That gap between paper and physical is widening, and history shows that when the two diverge long enough, reality eventually asserts itself. I'm not here to tell you what price comes next. No one knows. Anyone claiming certainty right now is selling you something. But understanding why this happened gives you an advantage most people never get. This isn't about predicting the next move. It's about recognizing the game. Here's the question that won't go away. If silver doesn't matter, why does it need to be crushed again and again? Why deploy the same mechanism 3 times in 50 years? Why coordinate margin hikes at critical moments? Why suppress something that supposedly has no relevance? You don't attack what isn't dangerous. You don't defend against what doesn't threaten you. Friday wasn't just a crash, it was a message, a reminder of who controls paper markets, and proof of what they fear. The paper price can be smashed, the contracts can be liquidated, but the metal remains. They can print money endlessly. Silver cannot be printed. One of those realities wins in the end. History has already shown which one. What you do with this information is your choice. But now, you see the pattern. And once you see it, you can't unsee it. Welcome to the hidden economy.